Good morning and welcome to the Global View. It's lovely to be here with you on the 20th of July, a Monday. I'm Nadine Blaney. Well, U.S. earnings will be led this week by Alphabet. Its AI spending outlook could shape sentiment across technology and semiconductor stocks. Results from Intel, IBM, Texas Instruments, and Tesla also loom large. Ongoing tensions in the Middle East and expectations for the Federal Reserve's next rate move remain key market drivers. Wall Street ended last week on a weaker note, with the Dow Jones falling 0.8%, the S&P down by 1%, the Nasdaq off by 1.4%, as investors continued to unwind position in high-flying AI and semiconductor stocks. In fact, the Philadelphia Semiconductor Index officially entered bear market territory, down more than 20% from its June peak. Despite the sell-off, though, the index remains up almost 65% this year. Valuations in the AI sector are also being tested after Chinese AI pioneer Moonshot unveiled a new open-weight model, Kimi K3, that it claims performs on par with OpenAI and Anthropic. In company news, Netflix tumbled 7.3% after that weaker-than-expected earnings forecast. Uber also fell after acquiring Delivery Hero's food delivery operations for $15 billion US. One bright spot was energy. The sector was the only gainer on the S&P 500 as oil prices surged on escalating tensions between the US and Iran. All that being said, earnings season has started strongly in the States, with 90% of reporting S&P 500 companies beating expectations. On the macro front, U.S. consumer sentiment rose to a 5-month high. Housing starts and building permits weakened. Industrial production edged up just 0.1%. Cleveland Fed President Beth Hammack was yet another Fed official, arguing that interest rates may need to rise, saying it's the first time businesses and consumers have been telling her inflation needs to be curbed. She is known to be hawkish. U.S. Treasury yields were little changed as investors weighed resilient economic data against those expectations for Fed policy. Tens were half a basis point lower. The U.S. dollar was broadly steady. The Aussie is sitting at about 69.8 U.S. Brent crude climbed on geopolitical concerns. It will remain in focus after the 8th straight night of attacks against Iran, and after 2 U.S. military personnel were killed in Jordan, with 1 still missing. Brent settled 4.6% higher to $88.10 a barrel. Brent is in early Asian trade above $90 per barrel. Gold also strengthened on safe haven demand. Spot gold was up around 1%. Copper eased amid the broader risk-off mood. Let's get some analysis, big picture. Matthew Goodson from Salt Funds Management is joining us from New Zealand. Matt, good morning to you. Thank you for joining us.
Morning.
So in New Zealand, we're also watching rates very closely, and the New Zealand swap rates, I think 3 years, have been rising. Why? What does this mean?
Yeah, no, it's quite interesting. The RBNZ hiked the OCR a few days ago from 225 to 250. That was largely expected. But since then, we've seen the whole curve move up a good 30, 35 bips. A mix of, I guess, the aftermath of that rate hike, quite a hawkish speech by the RBNZ chief economist, which suggests they're looking very closely at current heightened headline inflation expectations, and wary of that being incorporated into wage settlements, etc. And also we've obviously had the reignition of the Iran situation. So, things have been bottoming out, but that rate hike and that move 30 or so bips higher really matters here. That's the rate businesses fund off, and that's the rate that household mortgages are set off. So, we may well be on the cusp of a few modest mortgage rate increases here, given that most people have 2 or 3 year fixed rate mortgages.
Yeah, and how does the inflationary picture play into that as well? I mean, if we're bringing things to what's happening here and now, we're watching oil prices rising once again.
Yeah, look, we have our June quarter out tomorrow. We expect a headline number of around 4%, but most core inflation measures to be in the mid-twos. So within the 1 to 3% inflation band. The RBNZ, as mentioned, is wary of inflation expectations getting out of control. But at the same time, you look at what's driving inflation here, and it's very much several administrative prices, things like local authority rates being out of control, and also things like electricity line charges. A lot of other things like historically rental inflation and construction cost inflation have been major problems. That's no longer the case at all. They're very much back at zero.
So, what do you expect to happen in terms of the New Zealand economy? I mean, you've referenced house prices there. We're dealing with our own, slowdown when it comes to housing. In fact, our auction clearance rates haven't been this poor since the COVID crisis. So, what is the lay of the land?
Yeah, look, our house prices nationwide are down around 17% from their peak in 21, and it's a bit worse in Auckland and worse still in Wellington. But those were from unusually expensive levels. So, the market is starting to become, you wouldn't call it affordable yet. It's still slightly unaffordable in the grand historical suite, but nothing like what it was. Whereas you look across at Australia and you'd have to say it's only just getting started, given how far prices have run relative to the affordability measures, that apply to the average Australian. So, quite a different situation. What's driving our economy now is we've had a terms of trade boom from our rural sector. So if you look at Christchurch, which is absolutely booming, it's a very different situation to Wellington, which is in quite a deep recession, and Auckland, which has historically been driven by the housing sector, is just struggling to get its head back above water. So, it's a bit of a mixed picture for the New Zealand economy at the moment, but that terms of trade boom and interest rates, which even though they're rising, are still well below historical levels, probably the key positives that are out there. We just need the Iran situation to be sorted. It came along just at the wrong time as our economy was really starting to perk up.
Yeah, it's a shame. I mean, it's a shame all around, isn't it?
Indeed.
What has all of this meant for some of the listed companies in New Zealand? And I'm thinking about some of those listed retirement village companies that we talk about here that are, sometimes dual listed as well.
Yeah, sure. So, the likes of Somerset, Ryman, they have really made heavy weather of it over the last few quarters. Essentially, they are highly leveraged plays on house prices as they get to sell and then resell units over time as residents enter and then ultimately pass away after a few years. So, what they really require are house prices, steady increases in house prices over the long term, and they also need a vibrant housing market so that people can sell their house in order to afford the entry into a village. So, this housing sector really is a problem for them, and it's they're still very much in the tank, and there's probably not that many rays of light on the horizon yet for them. And if you look back several years, they were significantly larger companies and key drivers of our market. So, in contrast to them, we've had a couple of key names like Fisher & Paykel Healthcare, which is very much non-discretionary healthcare expenditure. Has probably been just about the leading medical device maker globally. And also the likes of Infratel, whose key investment, CDC data centres, I think has really distinguished itself as probably the leading developer and has its contracts chiefly with very deep-pocketed counterparties, which gives you a degree of surety about them. So our market isn't our economy. It's been driven by quite different factors. So, one sector taking the back, really falling off the wagon, if you like, in terms of the retirement sector. But FPH and Infratil are very much taking up the mantle.
Mm-hmm. Yeah, Infratil gets quite a lot of attention, quite a few mentions on AusBiz as well. Also, Fletcher Building today, it secured a government lifeline, so to speak, for a New Zealand cement manufacturing operation, which supplies about 60% of the cement that's being used in New Zealand. What do you make now of Fletcher Building's outlook? Because they really have been trying to do the hard work to get back on track.
Yeah, I mean, it's the obvious cyclical play on a stronger New Zealand economy. I think you certainly need a brighter outlook for the res and the non-res construction sectors. But markets are always forward-looking, and the market's really, I think, been sensing out a low in building activity. And as well as that, Fletcher Building's had an enormous number of self-inflicted wounds in the last several years, and current management and board are really starting to deal to those. So look, I think that subsidy to stay in the country is obviously helpful for them. The issue they were facing is we have a carbon tax regime, and that would be gradual. It was very generous when it first came into Woodson, but it's becoming less so. And that would put them at a significant disadvantage to major Asian makers who didn't face such a carbon tax regime. So effectively, that subsidy, if you like, is offsetting the impact of that.
Well, look, thank you. Just a quick thought as well. I think New Zealand's market is suffering a bit this morning. How do you think it will fare in this environment where we've got the tensions in the Middle East? I know that's not good for the New Zealand economy, but we have also got U.S. earnings coming out. A lot of the heat coming out of the AI trade. I mean, how do you reckon you'll go?
Look, our market's down a touch this morning, but it's barely open, to be honest. Mm-hmm. The volumes are tiny, so it'll pick up later in the afternoon. Look, we don't really have a great exposure to the AI trade except via Infratil, which is at a very high quality end of those exposures. So I think from here, for our market to pick up, taking a slightly longer term look, we need definitive evidence that our economy is starting to perk up, and at the same time that inflation's under control. Now, there's plenty of excess capacity in the economy, so the bull case is we could be in a sweet spot for a few quarters where the RBNZ doesn't have to hike very much, but at the same time earnings start to improve. So now that was the bull case that was beginning to emerge pre-Iran, which we've had to sort of put that back in the cupboard. Hopefully it can come out again.
Well, we've got Iran saying that local residents reported hearing several explosions in southern Iran, so continuing there. Nice to have
wonderful.
a chance to speak with you. I know amidst all of this. Look, have a good one.
You too. Thank you.
Matthew Goodson there from Salt Funds Management. We will check in now what we're expecting here locally. Up by 54 points to 0.6%. We'll be watching energy. Brent crude already above $90 in early Asian trade. We'll be watching gold, which did get a bit of a safe haven bid. I spoke with Mark Gardner from MPC Markets a little earlier on, and he reckons that the Australian market, the reasons why we haven't been outperforming up until now, absence largely of any AI trade, might actually be what saves us in the next couple of weeks. He's looking for potential outperformance from this local market. I'll bring you that interview in the first hour of trade. The Open is coming up next.